They are turning a static, inflation-vulnerable corporate treasury
An apartment building generates rent in fiat dollars.
actually outperformed spot Ethereum itself, transforming legacy mining hardware and fiat cash. Let's look at their actual holistic asset portfolio.
At a mere 1 cent per share, reveals a fatal flaw.
At a price-to-book ratio below 1.0x,
Something massive is unfolding with Bit Mine Immersion Technologies that could redefine corporate treasuries forever. They're pivoting into an 11 billion Ethereum powerhouse, but a sudden 61% drop in cash has sparked a fierce debate. Is this a financial masterclass or a dangerous liquidity trap about to snap? Let's break down the math.
historically, Alchemy was, well, it was this obsession with turning base metals like lead into gold, right? It was a quest for fundamental structural transformation.
The ultimate pivot.
Exactly. And today, we are watching a modern corporate version of this exact pursuit unfold right in real time on the public markets. We're looking at Bit Mine Immersion Technologies.
Which is fascinating because they began their operational life heavily invested in, the industrial metal of legacy immersion-cooled Bitcoin mining hardware.
Right. But now they're attempting this radical structural pivot. They are transforming themselves into the globe's largest corporate Ethereum treasury. It's an initiative that their leadership quite literally designates as the Alchemy of 5%.
Yeah, it's a bold title.
It really is. We are examining their August 2026 disclosures today, and to set the stage, there are really 3 key takeaways that will define the core of our debate right off the bat.
And those 3 points really highlight how unprecedented this whole move is.
Absolutely. So first, we have the staking pivot. Bitmine has accumulated over 5.8 million Ethereum tokens, and they are staking nearly 87.3% of them to secure the network.
Which is projected to generate what, like $257 million in annualized yield?
Yeah, exactly. $257 million. It fundamentally rewrites their corporate cash flow model. Then second is the liquidity squeeze. The company's liquid fiat cash reserves, like actual dollars in the bank, have plummeted by over 61% in just 2 weeks.
Down to $104 million, right?
Right, because they are aggressively deploying capital into weekly Ethereum acquisitions and just massive share buybacks. And third, we have the valuation disconnect. There is this massive canyon between traditional stock market valuations and reality.
I mean, a standard discounted cash flow model prices their core operating business at just 1 cent per share. 1 cent.
Yep, but yet the company sits on a staggering $11.6 billion asset footprint, and it's currently trading at a steep holding company discount.
The sheer scale of that footprint is undeniable. I mean, they are now the 2nd largest corporate digital asset treasury in the world, trailing only Strategy Inc.'s Bitcoin reserve.
Exactly.
But the central question raised by these August disclosures, and what we're really debating today, is whether this alchemy of 5% strategy is, an unprecedented masterclass in stock market capital allocation, or
if it's a trap.
Right. Or if it's a structurally dangerous liquidity trap that's just masquerading as a brilliant operating business.
So, to frame that disagreement properly, I think we need to support this analysis by explaining a couple of core stock market concepts, just so we can really understand the math behind Bitmine's strategy.
Yeah, that's crucial. Because if we don't ground this in traditional metrics, the numbers just sound like theoretical crypto math.
Totally. Specifically, we need to look at net asset value, or NAV, and the price-to-book ratio, or PB. So net asset value is it's simply the total value of everything a company owns, its assets.
Minus everything it owes, its liabilities.
Exactly. It is essentially the fundamental floor of what the company is actually worth if you liquidated it today.
Right.
Now, the price-to-book ratio compares the public stock market's valuation of the company's shares to that underlying net asset value. So if the PB is 1.0, the market values the company exactly at the worth of its assets.
And right now, these traditional metrics are being uniquely tested by Bitmine's digital asset balance sheet.
They really are. And my position here is that Bitmine's strategy is a highly efficient, deeply misunderstood capital allocation model.
Misunderstood or just structurally flawed? I mean,
Highly efficient. Look at the mechanics of what they are doing. They are buying back 19.1 million of their own shares, while their stock trades at a 0.9x PB ratio.
Sure, but
For context, the software industry average is currently sitting at 3.1x. By retiring their own shares at a massive discount to the mark-to-market value of their actual balance sheet, they are mathematically accreting or growing the underlying crypto asset backing for every single remaining share.
okay, mathematically, yes.
Furthermore, by taking non-yielding fiat cash and deploying it into staked Ethereum, they are turning a static, inflation-vulnerable corporate treasury into a dynamic cash flow generating engine.
See, I come at it from a completely different way. I'll concede that the pure math of the share buybacks works perfectly, in a spreadsheet.
It's not just a spreadsheet.
But businesses do not operate in a vacuum. They operate in a macroeconomic reality that requires liquidity, real-world dollars. I argue that Bitmine is walking directly into a working capital crisis, and they are compounding it with severe protocol risk on the Ethereum network.
A crisis? That's a bit strong.
By reducing their liquid cash from $268 million down to $104 million in just 14 days, the company is stripping away its operational buffer. They're exposing themselves to massive refinancing risk.
Okay, walk me through why you see that 14-day window as a crisis rather than just aggressive execution of a stated strategy.
Because if we use traditional stock market mechanics, we can't just look at net asset value. We have to look at the discounted cash flow, the DCF valuation.
Right.
For our listeners, a DCF model looks past the shiny assets in the vault. It projects the actual day-to-day operational cash flows a business will generate in the future and discounts them back to what they are today.
Which for Bitmain is
1 cent. The fact that Bitmain's DCF comes in at a mere 1 cent per share reveals a fatal flaw. It means the company's actual operations are essentially unprofitable without relying on highly volatile mark-to-market crypto gains.
well.
If you need those gains just to survive, your current strategy is built on deeply unstable foundations.
Okay, let's pull apart that first point of contention, because I think classifying this as a working capital crisis is a complete mischaracterization.
How so?
You are looking at the drop from $268 million to $104 million in cash and marketable securities and calling it cash burn. I see a deliberate, disciplined reallocation of capital.
Disciplined?
Yes. Over this period, they've been deploying $14 million weekly into Ethereum purchases alongside aggressive execution of their authorized $4 billion share repurchase program.
It is alarming working capital compression, no matter what label you want to apply to it. A 61% reduction in liquid cash over a 2-week window means their liquid reserves are nearing operational minimums.
They have a plan for that.
And we have to contextualize this within the mid-2026 macroeconomic environment. We are facing recalibrated expectations regarding Federal Reserve monetary policy right now.
You mean the shift away from the expected rate cuts?
Exactly. 6 months ago, the market was pricing in interest rate cuts. Now, driven by persistent inflation and this massive capital reallocation into AI hardware, we are looking at potential hawkish adjustments from the Fed. The cost of borrowing money is rising.
Sure, rates are a factor.
Simultaneously, the Clarity Act, the legislation meant to finally give corporate treasuries clear guidelines on holding digital assets, is facing procedural delays in the Senate. So, picture this. Macro volatility hits the crypto markets. Ethereum drops. And Bitmine's $104 million cash reserve is depleted by their ongoing legacy operations. How do they fund themselves?
They have options. They aren't entirely cornered here.
Their main option is tapping the capital markets. They would likely be forced to issue highly dilutive equity under their existing Form S-3 registration statement.
Which is standard for public companies.
And for anyone unfamiliar, an S-3 is basically a shelf registration that allows a public company to quickly print and sell new shares to the public. If they are forced to pull that trigger and issue new equity during a market downturn just to keep the lights on, it completely destroys the shareholder value they just created with those previous share buybacks.
I see why you think that. But let me give you a different perspective on the idea of burn.
Go ahead.
We shouldn't characterize exchanging fiat dollars for a productive asset as cash burn, Burn implies capital is being destroyed through, operational incompetence or massive losses.
Or lack of liquidity.
But Bitmain is strategically converting unallocated fiat currency, which is subject to inflation drag and debasement, into a yield-bearing asset. Let me give you an analogy. Think of a traditional real estate investment trust, a REIT.
Okay, I'm following.
If a REIT used its static cash reserves to acquire highly undervalued rent-producing apartment buildings at a steep discount, the entire stock market would applaud the capital efficiency. They would say, "Great job putting lazy cash to work."
Right.
So why penalize Bitmain for systematically converting zero-yielding liquidity into an asset class that is projecting $250 million in annual yield?
That's a compelling argument, but have you considered the fundamental mismatch in the nature of that yield?
Mismatch?
Your REIT analogy breaks down on one crucial point. An apartment building generates rent in fiat dollars. The tenants pay in cash, which the REIT then uses to pay its own cash liabilities.
Well, sure.
Bitmain's projected $257 million in annualized staking revenue is paid entirely in Ethereum. It is not fiat. And this brings us directly to the protocol hazards of their massive staking expansion.
You don't think the Ethereum yield can easily be converted to cover operational costs?
Not seamlessly and not without risk. Look, they have 5.06 million ETH staked. If they have fixed administrative overhead, if they have corporate debt service, or if they need to maintain their massive warehouses of legacy immersion mining hardware,
Yeah.
every single one of those bills is denominated in US dollars. If the broader crypto market drops, the dollar value of their operating capital drops simultaneously. It's like taking your company's entire payroll budget and locking it in a highly volatile foreign currency.
I wouldn't call it locked.
Aren't they then forced into liquidating their Ethereum at a loss or triggering massive tax obligations, effectively trapping their own capital just to keep the lights on?
The operational overhead is easily managed when you consider the sheer scale of the institutional moat they are building. This isn't just retail staking, okay?
No, obviously not.
Through their proprietary platform, the Made in America Validator Network, or Maven, alongside external partner nodes, they have staked 87.3% of their massive treasury.
That is a huge concentration.
They currently control 4.8% of the total circulating Ethereum supply, which is 120.7 million tokens globally. Their stated objective is 5%.
Which is a staggering concentration of network power.
It is, and it's brilliant. Controlling 5% of a global Layer 1 settlement network is an insurmountable institutional barrier to entry. No competitor can easily replicate that.
True.
It secures massive validator fee capture and creates a recurring yield that vastly outpaces their overhead, funding further token purchases without ever needing that dilutive financing you mentioned earlier. By integrating deeply into the consensus layer, they transition from a passive holding company into an active, indispensable network participant.
But active network participation brings active network liabilities. Unlike liquid spot digital assets that you can sell instantly on an exchange during a panic, staked assets are structurally illiquid during times of network stress.
Explain what you mean by structurally illiquid. They can unstake their assets.
Eventually, yes. But they are subject to protocol unstaking queues and lockup periods. The exit door is only so wide.
Sure, there's a queue.
If Bitmine suddenly needs that $104 million cash buffer replenished to try to unstake a large portion of its $9.8 billion stake position, they can't just access it tomorrow morning to make payroll.
Well, they wouldn't need to unstake the whole thing.
Furthermore, by running these validator nodes, they are exposing their corporate balance sheet to node slashing penalties, technical downtime, and smart contract vulnerabilities within the validator software.
I'm glad you brought up slashing, but the Maven infrastructure is specifically designed for institutional-grade security to mitigate exactly those technical risks. They aren't running this out of a garage.
Let me unpack slashing for a second for anyone who isn't deep into the Ethereum consensus layer. If your validator node goes offline, or if the software glitches and broadcasts conflicting information to the network, the protocol automatically penalizes you.
Right, to protect the network.
They actually confiscate a portion of your deposited Ethereum. Even with institutional-grade security, bugs happen. But beyond technical security,
My bigger concern is that tech doesn't solve the macroeconomic mechanics of the consensus layer itself.
You're referring to the yield rate.
Exactly. The yield isn't a magical fixed interest rate. The base staking yield on the Ethereum network is inversely related to total global network staking participation. It's a crowded trade.
It fluctuates, yes.
Right now, Bitmine is projecting its revenues based on a 7-day annualized staking yield of 2.63%. But as administrative initiatives like Project Crypto take hold across Wall Street, and as broader institutional staking grows across the network, that baseline yield is going to experience structural compression.
Because more validators means the block rewards get sliced into smaller pieces.
Precisely. When the network-wide yield structurally compresses and drops below 2.63%, those $257 million revenue projections require immediate downward adjustment.
Okay, but...
And again, because those rewards are paid in ETH, the fiat dollar value of this revenue stream remains fully tethered to spot prices. It amplifies our earnings volatility exactly at the moment when a mature corporate treasury wants stability.
I'm not convinced by that line of reasoning, because it isolates the staking yield and completely ignores the broader valuation disconnect, which is currently presenting a massive opportunity for investors.
An opportunity?
Yes. Let's look at their actual holistic asset portfolio. They have disclosed total combined holdings of $11.6 billion. That isn't just $11 billion in Ethereum.
No, they have the venture portfolio as well.
Exactly. They hold $180 million in Beast Industries, which acts as a private growth equity moonshot portfolio.
Right.
They hold a $69 million strategic stake in 8Co Holdings, which gives them indirect public equity exposure to OpenAI. They even hold 209 legacy Bitcoin from their early mining days.
Okay, but what does that mean for the stock?
When public market participants buy BMNR shares at a price-to-book ratio below 1.0x, they are getting leveraged exposure to this entire ecosystem. The public market is pricing the equity below the spot value of the treasury, essentially throwing in the venture capital optionality of Beast Industries and the AI exposure of 8Co completely for free.
I have to stop you there. The market isn't throwing anything in for free. The market is applying a standard, highly rational holding company discount.
Rational? At a 0.9x PB?
Yes, rational. Public markets inherently discount vehicles that hold digital assets.
Why?
Because as an investor, if I want pure Ethereum exposure, I can just buy spot Ethereum on an exchange or buy a spot ETF. If I buy Bitmane stock, I am forced to take on their management fee structures, their capital structure complexities, severe corporate governance considerations, and potential future tax liabilities on any realized gains they make.
But they offer yield that a spot ETF doesn't.
The stock's performance absolutely reflects this structural skepticism.
But they were just included in the Russell 1000 index. They have backing from major investment managers like ARK and Founders Fund.
And despite all of that institutional backing and index inclusion, Bitmane shares have dropped 42% year to date. They registered a 71% total shareholder return decline over the past 12-month period.
Markets are short-sighted.
That is exactly why that discounted cash flow model we talked about prices the fundamental operating value at 1 cent per share. When you exclude the mark-to-market appreciation of the digital assets, which they aren't selling anyway, the core operations generate ongoing net losses. The downside risk is entirely unanchored by traditional operating fundamentals.
That's an interesting point, though. I would frame it completely differently. Applying a traditional operating DCF model to a company that has been engineered specifically to act as a digital asset holding vehicle, well, it fundamentally misunderstands the business architecture.
I don't think it misunderstands anything. Cash flow is cash flow.
Evaluating Bitmine's strategy using a traditional DCF model is like evaluating a multi-billion-dollar bank vault based on the cash flow of its hinges.
That's a great analogy, but if the hinges rust shut, you can't get to the money.
But historically, if we look at previous market cycles, sustained outperformance of Ethereum relative to Bitcoin has been followed by periods where Bitmine's common stock actually outperformed spot Ethereum itself.
During a bull run, sure.
That illustrates the embedded equity leverage they've created during market expansions. When they aggressively retire shares at 0.9x book value, any subsequent rise in Ethereum spot prices disproportionately benefits the remaining shareholders.
It multiplies it, yeah.
It is a calculated, mathematical compounding mechanism that traditional finance models just aren't built to capture.
I will certainly agree that the leverage exists on the upside. If the crypto market enters a prolonged, multi-year bull run, the mathematical accretion of buying back stock below net asset value will absolutely multiply those gains for the remaining shareholders.
Exactly.
But my focus, and I think the focus of any prudent analysis, has to be on the asymmetric downside. Operating at a fundamental loss while tying up nearly all of your corporate capital in protocol-locked, highly volatile assets leaves the company entirely dependent on external market conditions.
Well, every company is dependent on market conditions to some degree.
Yes, but not with this level of fragility. If the spot price of Ethereum consolidates or drops, and that 2.63% yield structurally compresses like we discussed, the alchemy of 5% immediately turns into a liquidity trap.
You're assuming the worst-case scenario.
They will be holding billions in assets they cannot quickly sell, generating yield in a currency that is depreciating while their fiat-denominated operating expenses slowly but inevitably drain that remaining $104 million cash buffer.
Which is why the ultimate outcome heavily depends on the broader structural changes happening right now in the institutional digital asset space.
Yeah, macro matters.
From my perspective, Bitmine represents the absolute frontier of corporate treasury management. They have successfully utilized traditional stock market mechanics, specifically by aggressively buying back undervalued shares, to build the world's largest yield-generating corporate Ethereum reserve.
This is huge. I'll give them that.
They're demonstrating how a modern company can convert a static, melting fiat treasury into an active, productive asset base. They are moving beyond traditional operating metrics to function as an institutional proxy for Ethereum validator economics, complete with that embedded venture capital optionality we talked about.
And on that front, we certainly agree that Bitmine has created a highly novel, high-leverage corporate structure. It absolutely requires looking past traditional operating metrics to fully grasp what they are attempting to build.
Right.
But the structural realities of how a public company must operate cannot be ignored. The scale of their Ethereum treasury is impressive, yes, but operating at a fundamental cash loss while voluntarily walking into deep working capital constraints leaves the company dangerously exposed to any macroeconomic shocks.
It's a calculated risk.
Investors really have to weigh the beautiful mathematical accretion of the balance sheet against the harsh operational realities of liquidity compression and, the structural hazards of locking your assets inside a consensus protocol.
And as macroeconomic conditions shift in the coming months, whether that is through the potential passage of the Genius Act, which could finally clarify the tax treatment of these unrealized digital asset gains,
That would be huge.
or through Federal Reserve policy adjustments dictating the cost of capital, the ultimate success of this strategy remains to be proven by the market. We have watched Bitmine attempt a massive structural pivot, transforming legacy mining hardware and fiat cash into a modern digital yield engine.
It's definitely a fascinating experiment.
The question moving forward, which our listeners will have to weigh for themselves, is whether this alchemy of 5% strategy has successfully synthesized the gold of a new financial era, or if they are simply burning the laboratory down.